Ladies and gentlemen, welcome back to the channel. Now, I think this is probably the most consequential video that I've posted on this channel in quite a while. See, I've been calling for maybe a 10% correction in the S&P for the last couple of weeks. I said really in July, and you've started to see a lot of that correction already. But there's something bigger happening here. Okay, there's really I guess three pillars of our markets, especially right now. There's inflation. What's inflation doing? Inflation's coming in good, and we'll talk about that in just a moment. There is the economy, and there is earnings. These three things are the only things that really matter for the markets right now. The Fed is obviously important, but they pretty well televise what they're going to do. And unless the inflation situation changes, then the Fed's just going to do what the markets price in. They always do. And we'll look at that throughout this video as well. But I think we can expect just a very volatile trading range. Not hit new all-time highs, but not necessarily plummet or crash as well. Heading into the big one, there will be a big crash. Now, to the timeline of this, not 100% sure, but there are things to consider. And there is a potential path, at least to a larger correction at some point over the next couple of months. But in the near term, as long as earnings do not disappoint in any kind of large way coming next week and the following week, specifically with big tech, you're probably over with this straight down price action. And I'll explain all of these things throughout this video. There's one central, very critical idea here. You need to be getting ready. You need to be getting ready for the big one, for the big crash, for the big buy the dip opportunity. Because let's be honest, is this a buy the dip opportunity? Not really. No. I mean, is this an exciting opportunity to get into markets? Absolutely not. Small caps look like they're going to outperform. But with the potential risk of a recession, is that really an attractive place to be right now, besides just some kind of swing trade? Let me know what you think about all of this information down below in the comment section. Also, I would like to thank all of the channel members. I think we're currently at like 30. So thank you if you guys have chosen to become a member and support the channel for like $5 a month. Very much appreciate it. And you know who else appreciates it? This guy. It buys him like 5 cans of Poofs a month. 5 the 4-packs. This kid loves them. So first off, to start this video, let's just read the post that I wrote on the X account last night, because I was really thinking long and hard about all of these topics. I was doing a lot of research at the time as well. And I say, so look, markets are now in a volatile trading range. Markets are going to be volatile for months, for at least the next couple of months. That slow kind of nothing going on, just melt up in markets is over with. Okay, that's the first thing we need to acknowledge. This is a trader's market. So if you're someone that is actively trading this market with any degree of confidence or skill, perhaps you've been doing this for a couple of years, this is your perfect market. Because judging on what happens on a day-by-day basis, Fed's hawkish or dovish, you're likely to get some pretty big volatile moves, and that can be great for day trading or swing trading for that matter, and potentially get a couple up days, a couple down days. But you can get, I mean, we've seen volatility we have not seen in a very long time. Yesterday, markets fell 0.6% or so negative, rallied over 1% positive, and then went negative again by the end of the day. Like, that is a day trader's like perfect market. Okay, so this is a good time to potentially make a couple trades and save up some cash. Now, obviously, that's not for everyone. You can lose money just as easily as you can make money. If not, more easily can you lose money. But I have found this has been a pretty good market to make some trades and stack some cash, okay? And we'll talk about cash in just a moment. Obviously, that's not a recommendation to go out crazy trading this market, but it can be a good kind of market environment to do that if that is something that you guys like to do. Now, I say that the S&P is likely to stay between 530 and 550 until the September period when we could get an election correction. Now, we usually get some kind of election correction in October. I think it's probably going to be pulled up to September. Specifically, the debate, I believe, is going to be around September 10th. And whenever we start to hear more about policies, that's going to be important. And, Trump may or may not be good for markets to some degree. This tariff situation, could be important. If you were investing back in the markets in 2018, it was the tariffs and the Chinese trade war that caused markets to drop about 20% in about a week, okay? About a week and a half maybe, towards the end of December. And that was the worst December you had seen since, I believe, the global financial crisis or Great Depression, something along those lines back in 2018. It was quite aggressive to the downside. So Trump overall can be good for markets, but still there's things that markets are not going to like. Same thing with Kamala Harris, although we don't know what her policies are going to look like. So I think it's a little early for markets to have this election correction until we have a better understanding of what both policies are going to be from both sides of the potential, president. Okay. So I think we have some time left on the clock before that election correction comes, but normally you get an election correction. So don't be surprised when that happens. Now, I go on to say this sell-off is a typical disappointment from high earnings expectations. That's it. It also happened after last quarter. So indeed, if you look at last quarter, after last quarter earnings, we basically just melted up, went straight up throughout all of Q1. And then what happened? You ended up falling 6% because earnings came in not as great as expected. And then markets bottomed and went higher again. Well, so far from peak to fall, you've fallen about 5%. Okay, great. That's roughly the same. Perhaps that makes sense. Okay, earnings are not coming in bad by any stretch of the imagination. As Fundstrat says, and Tom Lee, quote, of the 199 companies that have reported so far, about 40% of the S&P 500, overall 69% are beating estimates, and those that beat are beating by a median of 6%. So it's not as great as normal when you usually have over 74, 75, almost 80% of companies that beat estimates. But again, those that are beating by a median of 6%, which is pretty much in line with the historical, average. So from my perspective, this drop in markets is just based on earnings expectations that were too high to begin with. And we're just not getting those knock your socks off reports from Google and from others, even like Tesla, in regards to AI just yet. I think it'll come. But I think Wall Street gets way ahead of itself, expecting these fantastic AI numbers way too soon, okay? So just like first quarter, we're getting that again for the second quarter. And there could still be a little bit of selling left. Again, I'm expecting a range between 530 and 550. We came down and hit about 537. So technically, if we were to fall to 530, the low end of this range that I'm forecasting, that would technically put you down from top to bottom correction about 6.3%, which is closer to what we had at the end of Q1. And that will largely depend on what happens next week with your other big tech names, Apple, Microsoft, the guys that have massive market caps that have not reported earnings just yet. And I think specifically with Apple, there's going to be quite a few disappointments there. And Apple is a real problem child heading into their earnings. Now, I want to be clear that Wall Street is delusional. Delulu. Straight, just delulu. Expecting a soft landing. Now, I will give it to you. Things have looked okay so far. GDP came in at 2.8%, which I know if you're a sophisticated investor, you know GDP was not really 2.8%. It was mainly due to inventory buildup. Government investment had a big role to play there, and one-off instances. If you exclude all of these kind of one-off things, especially inventories, GDP actually came in at 0.6%. That's measly. That's bad. That's not good. Okay, that's getting close to recession. But let's also be clear. Wall Street does not give a rat's ass where the GDP comes from. They don't. Even if things look bad and the consumer's doing bad and defaults are exploding. Wall Street just cares what that GDP number looks like. Doesn't matter where it comes from. It could all come from inventories and everything else could be terrible and Wall Street would still cheer. You know, that's just how Wall Street is. It's this, you know, Wall Street at this point, it's not Wall Street, it's algorithm street. The algorithms just care about what the overall number is. Don't care about anything else. Okay. Now, I go on to say the real question is when, not if we enter a recession or at a bare minimum, a growth scare, which could also lead to a 20+% pullback. So if you're thinking about, the next great buying opportunity, it is either from a growth scare or an outright recession. Now, obviously, the growth scare comes first and then recession likely, therefore afterwards. And you know, there's another case to be had as well that on average, the S&P tends to fall about 23% when the Fed starts cutting rates. But that's usually because the Fed is late to cut rates. They usually cause a recession. By September, I don't know if the data is going to be looking really bad. From my perspective, the government does not want to release bad data before an election. Take that as tinfoil if you want. But there's a reason the data has been overstated for over a year now. It does not give you good odds of winning a re-election as the current administration if you have data that looks like we're going into recession or people are, losing jobs or things like that. So is it possible that we get bad data before the election? Sure. I think it's pretty unlikely. Okay. So with the GDP report we got today of 2.8%, even if GDP gets revised down 50%, which would be a huge revision over the next 3 months, you're still going to be coming in at about 1.4% GDP, which is the same as we had for Q1. That would be below trend, but not recessionary. So I think that number really bought you a little bit of time from the growth scare perspective. Now, if you remember from yesterday, you actually had durable goods orders that came in at negative 6.6% month over month. That was the worst number we have had in years. That means that in real time for last month, for the month of June, the economy may have really started to weaken. Now, it's not just GDP that potentially will give the markets a growth scare, although that is very important. It's also retail sales, consumer spending. It's all of these other data points. And again, I don't think they're gonna, look really bad before the election. It's possible they do. I mean, they already don't look great, but enough to start baking in some recession risk or some recession fears. I don't know. Okay. And that's what I say in this post. With a GDP report we got today at 2.8%, I don't think Wall Street will price in a growth scare for a while. And I say, yes, I get it. GDP was only that strong because of inventories, government spending, and one-off instances. Excluding those, GDP was a measly 0.6%, but Wall Street doesn't care. They care about the number. Bottom line. At the same time, durable goods orders came in at negative 6.6%, showing the economy could actually be weakening pretty fast in real time. Does Wall Street care? No. Don't fight it. Unless earnings start coming in worse than expected in the coming weeks, we probably have most of the near-term selling done. It's the recession/growth scare that is the real problem, and don't be confused. That is coming. The question is again, when, not if. Cash is king. Now, why do I think Wall Street is delusional or delulu for expecting a soft landing, expecting this no landing, no recession environment? Because let me just be honest, that never happens. After you see a rapid rise in inflation, government numbers had us at 9% at the high, almost 10%. But let's be honest, when you're watching food prices go up 30, 40%, 50% in just a year or two, when you're watching your escrow for this house that I bought, escrow alone, taxes, insurance, has went up over 40%. I mean, that has boosted the monthly payment with a fixed interest rate of what I get, 2.75%, so something super low back in 2021. This mortgage is up like 30% just based on those added taxes and insurance costs. I mean, when people are looking at the real inflation out there, it's bad, okay? People cut back. Eventually, their savings get depleted, which has happened already. All of your excess savings is gone. That's why Wall Street doesn't talk about it anymore. You were over $3 trillion in excess savings at one point about a year and a half ago. That's gone. That's now negative, about $300 billion. And I'll give you a little bit of insight, okay? So my mother manages a restaurant, okay? And I work there sometimes on the weekend specifically. Actually going there today. And do you know what's been happening? Is so basically how it works when you're a server, right? And you get paid out at the end of the night, okay? When you take in cash, that's offset by your tips, right? So when you have 5, 6, 10 servers, whatever it is, and the restaurant's doing 5,000 in sales, but they're only bringing in 1,000 in cash, and the other 4,000 is being paid on credit cards. If you have 5 servers that make $250 a piece, well, now you're negative $250. Because your tips get offset by the cash that you bring in. So long story short, what's been happening over the last couple of weeks specifically is you've started to see a rapid rise in the use of credit cards. So kind of correlating with the data that we're actually seeing now, people are really spending on credit. And this can last a little while because people obviously don't want to change the way that they are living. But they're not using cash anymore. They're just not. They're not using debit cards as much anymore. They're using credit cards. And again, excess savings are now negative, almost $300 billion compared to where they were during the pandemic era times. And that's kind of a real world heads up. Like, oh man, this can't last forever. People are going into debt, a lot of debt, at a rapid pace, and that's just not going to end well in the near term. And again, historically, when inflation surges quickly, you get recessions because people cut back. Wages do not keep up with the inflation we have seen. What the government numbers say, 16% wage increases we've seen since 2020. Inflation is up far more than that. Trueflation is like 40%. It's not the 20% that the government says. It's way worse than that. So people are substantially underwater right now. And that's just not going to end well. It might take some time because there's more use of credit cards now than maybe there was in '08, for an example. But eventually, the chickens will come home to roost. The question really is, does that happen towards the end of this year? I mean, if you want my honest opinion, December could look like 2018 again. I mean, if you want my honest opinion, could get a sharp drawdown in the month of December. But that's just speculation. This could happen at some point in 2025. But in the not so distant future, there will be a massive growth scare. There will be recession fears that start to come back into markets, and this market will look like 2022 for a period of time. Yes, it will happen. And while, small caps can outperform between now and then before the growth scare starts as the Fed starts to lower rates, I really think cash is king right now. Taking profits from things that maybe you don't want to hold during a recession. Like, look at your portfolio right now and say, hey, if we go into a recession next year or towards the end of this year, do I really want to own that? Is that company going to survive a recession? If you doubt that at all, you probably want to take some profits in that name. Now, I have like 45% of my portfolio in Tesla. I'm not selling Tesla at all. I'm not buying puts on Tesla, at least right now. When that moment does come, when that opportunity does present itself, and we do get that rapid 20-30% crash, I will be there to take full advantage of it. I will extract the value out of hedging my portfolio and redeploy that at the bottom of the markets in Tesla, in other quality names. Do not doubt that for a second. If you guys want to come join the trading community, check out that link down below in the description of this video. But I think it's going to take some time. I think you've probably seen a lot of the short-term selling that is over with. Are we going back to all-time highs? No, I don't think so. No. I mean, it would take something pretty dramatic to get us back to new all-time highs. Now, perhaps maybe the Fed cutting rates could get people excited, although, again, the historical precedence is you normally fall like 23% of the Fed cuts rates. But if markets are still perceiving this soft landing narrative as actually happening, it's possible you could perhaps hit new all-time highs by the end of this year. But I firmly believe you're going to have a much better buy the dip opportunity in a lot more, I guess, of broader names over the next couple of months. And I do anticipate we will get an election correction, but that's not necessarily what I'm talking about here. Wall Street is, again, delusional, expecting a soft landing or no landing. And the fact that that's not even really a view at all by many on Wall Street, there's only a couple people that are actually calling for a recession, like Peter Burskin, PCA Research. You could literally name them on just a couple of fingers, right? You don't even need the whole hand. You just need a couple fingers. It's so far from the consensus view right now, which, again, if you're a contrarian, that just kind of tells you everything you need to know. I think you want to be a little defensive right here. Just a little defensive, although this is going to be a great trading market for maybe the next couple of months. Again, I think Wall Street is way wrong about this whole recession issue. And we could go into each specific point and data recently. I'm going to assume that you guys kind of understand the consumer's not doing that well. I mean, the economy is really not doing that well. If you look at corporate earnings, like, they're not saying the consumer's doing very well. Like, anything that's related to the consumer is getting destroyed on earnings. Take a look at Nike. I mean, that kind of tells you everything you need to know. Wall Street's delusional, not pricing in any risk of a recession today. That's my opinion. I'm not going to fight Wall Street on that. No way. That's a losing fight every time. Markets can stay irrational longer than you can stay solvent. I believe that's a quote from Warren Buffett. Yeah, I'm not going to bet against this market for any period of time here, but I am vigilantly waiting because the growth scare will come. The recession will come. And the big opportunity will also come. And when that does come, I want each and every single one of you guys to be prepared to seize that opportunity. Because after that, I think we're probably going to see a raging bull market for maybe a decade. But we'll see. That's obviously uncertain, and that's very hard to tell. But typically, inflation booms tend to lead to higher corporate earnings for many years to come. So from that perspective, I think the inflation argument does bode well for markets longer term. So let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel. Again, I just want to be very clear, around September or so, I think an election correction is likely. And I think just a lot of up and down volatility we can expect from now until September. Then perhaps maybe November, December, you get a larger growth scare, or Q1, Q2 of 2025. I'd be surprised if it was second half of 2025 when we get that growth scare, but that's a possibility you should also be open to nonetheless. So again, you guys enjoy the rest of your day. I don't want to squeal on and on all night. Let me know what you think about this information down below in the comment section. You guys have a fantastic rest of your day, and I will see you in the next one.